I want to welcome you all and thank you for attending sFOX's webinar featuring Valmar Capital on the best ways to get exposure to crypto as a sophisticated investor in 2023. I'm your host, the head of content at sFOX, Aaron Suduko. Really excited to be welcoming you all to this, not only for this particular event, but also as a kickoff of a series that sFOX is really excited about. It's Crypto Asset Allocator series. Where we're basically trying to dive into the current state, past, present, and future of crypto, recognize that it's evolved quite a bit in not so many years, and have conversations with some of the most sophisticated players in the space and get their insights on what it's like to seek alpha in crypto, not just as a curiosity, but rather as a rapidly evolving and maturing asset class. To that end, today, I'm really excited to welcome Jack Finio, the head of product from sFOX, along with three of the principals from Valmar Capital. We have Jonathan Mann, co-founder and CIO, Luca Toscani, co-founder and COO, and Joe Cox, partner and head of business development. Gentlemen, welcome. I want to thank you so much for taking the time to share some of your insights. I think we're going to have, I know, in fact, we're going to have a really fun hour together. But before we do so, I want to invite you all to just go around and quickly give our attendees and viewers of the video after the fact a little bit of information about who you are and what it is you do.
Yeah, absolutely, Aaron. We appreciate it. We appreciate the introduction. Pleasure to be here. Valmar Capital, who are we? We're a scalable multi-strategy, multi-manager platform, specifically for crypto markets. What we're doing here at Valmar is we're looking to really build the institutional gateway for digital assets. We're designed to deliver consistent, uncorrelated absolute returns through a diversified blend of investment strategies, institutional grade infrastructure, cutting edge technology, and rigorous risk management processes. I think, some themes that you'll hear from us on this call are really, using the experience and the rigor and the discipline of experiences in traditional finance, married with bespoke specifications and digital assets to really create that institutional bridge. You'll hear a lot from us about risk management. You'll hear quite a bit from us about capital efficiency, and you'll hear from us about the need for, really a diversified blend of exposure in this space for good yield, strong volatility and risk management, and just strong diversification purposes across the board. And TLDR, good news, there still are a lot of great managers out there.
And an optimistic TLDR.
I would add, not to be confused with the fund of funds. We're a platform that models after the successful cases like Millennium Capital in TradFi, or Brevin Howard, Point72, and this guy. So one fund allocating capital to different types of pods, internal and external.
And I'm sure we'll hear a lot more about not only those themes, but also the ins and outs of Valmar across the next hour. Jack, would you like to speak a bit to the sFOX side before we dive in here?
Yeah, sure. Thanks, Aaron. Hi, everyone. Jack Finio, head of product here at sFOX. sFOX is, a full-service crypto prime dealer. We provide kind of global access to liquidity, secure custody, and reliable, low latency trading infrastructure. Our focus is partnering with clients, our clients, to give them a platform by which they can really unlock the full potential of opportunity in the digital asset space. Personally, I've been in crypto since 2015. Prior to joining sFOX, founded a quant systematic crypto fund, focused on kind of shorter term trading signals. That was back in late 2016, and yeah, very excited to dive into some of these topics with the Valmar team.
I'm excited too, and we have no dearth of topics, and as always, not enough time to dive into all of it. So we will jump in just to give the audience a little bit of a roadmap before we do so. We're going to have, I'm sure, a free-ranging conversation about all corners of sophisticated capital and how it's approaching crypto and how you might want to consider approaching crypto if you're just getting into it for the first time. for the majority of the hour, but we're also going to have some time at the end for Q&A with the audience. So attendees, if you're interested in asking any questions of our esteemed panelists, there is a Q&A box right at the bottom of Zoom. Feel free to submit questions as they come to you, be it in advance or over the course of the hour, and I'll make sure we block off a few minutes at the end to address some of those as well. Jack, as you mentioned, you've been in the space for quite a while, since 2015, and you have the interesting perspective of having put together your own fund before moving in-house to sFOX to basically build product to make asset management easier for funds and other sophisticated players in the crypto world. So I would love if you could talk to your personal experience in terms of, maybe what you've struggled with when you were putting together your own fund as a trader, getting exposure to crypto, what you've seen others struggle with, and how sFOX over the years since its inception has worked to create solutions to those problems that sophisticated traders face in the market.
Yeah, thanks, Aaron. I think my answer is very intertwined, kind of across my own experience, and now building products for sophisticated traders with sFOX. We started the fund because we saw a lot of opportunity to find kind of unique alpha within the digital asset space, and with our fund, which was again kind of systematically trading on pretty short time horizons, the struggles that we most commonly faced, and I think our clients most commonly face, which is why I was so excited to join sFOX, were the things that either take time away from the trading strategy itself, limit the deployment of that strategy, or limit the scalability of that strategy. And I think these tend to manifest themselves in kind of four distinct areas. One is fragmentation. Crypto is a highly fragmented asset class. Specifically on the trading side, there's thousands of different exchanges, and different pools of liquidity across CeFi platforms, OTC market makers, decentralized exchanges. And the best venues to actually execute a trade are constantly changing as well. The issue is that each of these venues are unique, and whether they're a CeFi platform or DeFi platform. So both managing these integrations and adapting to changes in these kind of best venues for execution really takes time, a lot of time away from the trading strategy itself, because you're really not building anything for the strategy. It's just kind of infrastructure type integrations in order to access the best pools of liquidity to execute a trade. With sFOX, we aggregate liquidity from global exchanges, OTC market makers into a single order book across across pairs and across markets to really simplify that for our clients. Right, it essentially solves for that fragmentation by just bringing it all into one platform. The second area is typically microstructure. Right, liquidity and spreads can be volatile. Recently, liquidity has gotten lower, spreads have gotten wider, and again, this is a matter of adapting to changing market conditions, ensuring that the liquidity providers that you are trading with are offering kind of the deepest liquidity and tightest spreads. And again, this is where sFOX's aggregation and integrations with these liquidity providers really gives our clients an advantage when executing their trades. The third area would be capital efficiency. As an active trader specifically, you really need to be able to quickly enter and exit positions with a CeFi exchange. However, you typically have to pre-fund your account. If I want to sell one Bitcoin, I have to have one Bitcoin in that account, and that takes time, right? If the best place to sell that Bitcoin is on exchange A, but your Bitcoin is on exchange B, that means you have to move those funds over in order to enter that position or exit that position. But with sFOX, we make this very efficient. We handle both the treasury management and settlement to ensure that liquidity is available across these venues at all times for our clients, and offer the ability to gain both short and long exposure to a particular asset on the platform. And then finally is execution, or I think execution kind of combines the three other areas I mentioned earlier. where, as market conditions change, as microstructure changes, order execution has to adapt to those conditions as well and ensure that it's always sending a trade to the right venue. We're constantly iterating and innovating in execution. We offer a suite of proprietary order types and algorithms on the platform, most of which were developed kind of hand in hand with our clients' use cases in particular. So we really take pride in kind of partnering with those clients to ensure that we give them the tools that they need to execute efficiently.
Yeah, it's interesting. If just kind of playing off of what you just said, and that's kind of similar to our what we see our role at Valmar is too, right? Like, obviously, our goal is to provide risk-adjusted returns to our investors, right? And the way that we kind of achieve that is through diversification, finding the best strategies and the best managers to run those strategies. But in order to achieve that, like we think a big part of our responsibility is also to kind of be a platform and kind of like an out-of-box type of solution from the fund management side for sophisticated strategists or traders or managers to plug into, right? So like where somebody might have an amazing strategy with tons of alpha in it, but they don't want to take that time to set up a fund structure or to deal with the day-to-day headaches of running a fund. They just want to trade, right? They just want to run their strategy to the best of their ability. And that's the perfect type of manager for us to work with, right? Where we can provide that institutional setup that passes the rigorous diligence that a investor requires, but provide that to a manager to allow them to just seek alpha and generate alpha.
Now, Valmar team, maybe we can take a step back for a second, because I think those connections between what you're doing and sFOX are really interesting. But one kind of point of distinction is that sFOX has been around for quite a while, whereas you guys are really kicking things off and getting started much more recently. And I imagine that some people in our audience might find that interesting, especially if they're just looking into exposure to crypto in the first place. So, all of us talking, we've been around digital assets for a pretty long time. We're familiar with it, but to people who might be looking at it from the outside, I mean, it kind of broke into popular global news cycles back in 2017, 2018, and kind of has since faded from the spotlight more or less. Although, if people are watching the news and tuned into crypto, that it's continuing to make news. So I wonder, given your approach to asset management and portfolio management in general, what kind of inspired you to take on building Valmar Capital, and given the particular position in which the market is now, what headwinds and tailwinds have you experienced throughout that process?
Yeah, absolutely. Look, we're doing this because we think the timing is right to do this now, right? We're dealing with a few different particular traits of this developing asset class, right? We feel like we're at a point where this asset class is established. There's a current market cap of about $1.2 trillion. Daily trading volume floating between 30 and 32 billion on any given basis, right? And we've even seen in the last 2 weeks here, right, continued growth of institutional adoption. We don't really have to look much farther than filing some of these ETFs and launch of EDX markets, et cetera, et cetera. We know that this space is massively evolutionary and consolidating at an extraordinarily rapid rate, right? Technology, innovation, opportunity sets, and risk management, quite frankly, evolve rapidly. So there's a necessary survival of the fittest to this game, and there's been a necessary trimming of the market, right? So we feel like a lot of fat has been shed out of the market in the last cycle, and quite frankly, to move forward with a long-term view, right, we have to address sort of the violent volatility that does exist in this space. But as Jonathan would dive into more, that's quite frankly how we how we view investment, right? How do we get exposure to the asset class while managing the volatility and the downside risk there? And for us, we're believers in the asset class, right? And so we're currently sitting in a bear cycle right now, where we believe that there are discounts to be had. There's a lot of upside to be had, as long as that vol and risk is managed appropriately. So for us, from the investment management perspective, it's great timing. And access to managers is fantastic as well, right? I mentioned in the beginning, there's still great managers out there. And this is a time to be able to develop strong relationships with maybe some of those managers that had a more limited capacity before.
Yeah.
Sorry, Jonathan. I wanted to add also that we have all of us have a combination of traditional finance and crypto experience. So we have seen what has been working in traditional finance, and observing what happened in the crypto market in 2022. I think 30-40% of the funds were wiped out, and we kind of observed what was going on, and we really observed also the success models that are being brought forth by again Millennium Capital, Brevin Howard. I mean, all of the most successful TradFi hedge funds have a certain type of strategy, which is multi-strategy, multi-manager, flexibility, adaptability to the market cycles, and very, very strong risk management. And that's what we think we want to bring to this place. It's why starting now. Obviously, it's a tough period in the middle of the bear market to start a hedge fund, let alone in crypto. But it is the right time to build something. And in our opinion, it is good to borrow from traditional finance what has been working very successfully there, and try to pioneer our way into crypto that way.
Luca, I'm really glad you brought up your team's background in traditional finance, because I love the comparison between what you guys are trying to build and what you've seen be successful in other funds outside of the crypto world. But I'm also interested in how that might inform how you think about the asset class itself. Like Joe, as you said, you view the crypto asset class as established now, more or less, right? And given that you guys have had a range of experience outside of crypto too, do you think there are interesting comparisons or insights to be gleaned from comparing it to other assets, whether that's real estate or traditional equity or anything else? Or do you think it's kind of its own animal that needs to be understood in its own terms?
I think it's a mix of both, right? There's definitely parallels to, a lot of times people think of crypto as like liquid VC, right? There's a lot of parallels to emerging markets, a lot of parallels to like frontier markets, but at the same time also its own kind of unique differences, right? And like one specific one is just kind of like we had to invent our own word around this term, like tokenomics, right? And what does that mean? It's like the supply and the emission schedule of a token, and I think a lot of times, like sometimes when you try to apply like traditional equity analysis to it, you kind of leave out the tokenomics. At least there's the risk that you do, and obviously in such a nascent market is such a important factor. Another thing that's different is kind of like every token's created has its own kind of unique specifications and different types of value accrual or lack of value accrual mechanisms, whereas like equity is equity. There's no real difference in terms of like an Apple stock or a Microsoft stock. It's still the same legal structure. The economics behind it of the business might be different, but here in crypto there's like an extra layer of complexity because of the token. So yeah, I would say there's similarities, maybe in terms of like market structure, volatility, to like frontier markets, potentially dialed up a little bit more in crypto, but then from a fundamentals point of view, definitely has its own kind of like unique characteristics.
Jonathan, I love that you brought up this idea that we had to invent our own word, tokenomics, for even evaluating sort of the way the tokens work, contrary to something like Microsoft stock or an Apple stock. And I wonder, as you think about valuation models in crypto now, given that, you know, as Joe was saying, it's a little bit more settled and established an asset class than it was a few years ago, do you see the question of valuation models and how to determine what a token is worth as like a settled matter, or something that's continuing to be an ongoing question and debate as the asset class itself continues to evolve?
Yeah, no, I mean, I don't think that it is a settled debate, right? There are a number of different types of frameworks that are popular in crypto, right? Like you may compare tokens based on like if they're yield bearing, like the relative yield, or you may compare things based on like a very common thing in the prior cycle is kind of like a price to sales multiple, which sometimes is applicable, sometimes is not. So I think there isn't like a consensus valuation model in crypto. And because tokens aren't like a standardized thing, as I said, like I think each different token or different style of token may have its own different type of valuation model. And I was talking to somebody else who kind of like is working hard on like, you know, applying, she actually came from like a value investing background. And I think there's definitely the room for this to work in crypto, but you know, and we were talking about how like even in equities, like different types of valuation frameworks work better depending on which part of the cycle you're in, right? Like when you're in like a high momentum growth environment, like the metric on like a social media site would be like dollars market cap to eyeballs, right? Like, and that can work, right, for a certain period of time. And then when the market's trending down again, then you have to be able to pivot and recognize that moment and pivot to a different valuation model. Like, okay, how do I get back to like, you know, fundamentals and say, okay, this is an attractive PE or attractive PEG ratio, like things like that, right? So I think that's some of that can also be the case in crypto as well, but we're still trying to figure it all out here.
But you know, to add to this point, I think in the first few years, you know, the narrative was definitely more dominated by, you know, arguments like, okay, is Bitcoin worth $1,000 or $1 million and what about valuation? But to the point and the very point of this, the topic of this webinar, you know, to us, it's almost like irrelevant. There is a place for fundamental and debating about what token is valued for, but at the same time, there's a variety of other strategies, and the asset class is an amazing source of uncorrelated alpha that other asset classes you know, don't have, because you know, they're much more efficient, they're much more crowded, and therefore you know, our approach is yeah, you know, we'll have a place for, you know, there is a place for fundamental research and tokenomics and understanding what the value is if they ever get to that point. But at the same time, there's market neutral strategy, there's systematic, there's discretion, there's a CFI, DeFi, there's you know, a spot derivatives. It's an amazing you know, Wild West where, you know, people can actually, and investors, including institutional investors, can find alpha that they're just simply not able to find that anywhere else.
As long as the risk is managed appropriately.
Yeah,
That's right. Yep.
Definitely. Well, I love that you guys brought up this idea of diversity, just different types of token and types of products and opportunities in general in the crypto sector. Jack, I wanted to kick it over to you and ask, you know, especially given your tenure in the crypto sector and your time between building your own fund and then working in sFOX. How have you seen that diversity of opportunity longitudinally? Do you think that there are different opportunities now than there were like 5 or 10 years ago? And as you think about the question of sophisticated capital in crypto, whether that's a fund, a family office, an individual investor, or whatever, what kind of infrastructure do you think is really important for them to be able to capture those opportunities as they not only arise but also change with time?
That's a great question, Aaron. I think overall, right, just looking at the asset class as a whole, I think there hasn't been much change in at least my view on the fact that there is so much opportunity available in the asset class. It might not seem that way from the outside looking in because we're at a different point in the market cycle. But at the same time, right, the asset class is still expanding. New opportunities are presenting themselves every day. And I'll go back to Jonathan's point earlier too, right? It's more about pivoting that framework given your point in the market cycle. Maybe opportunities that weren't attractive at peaks in the cycle are more attractive now, or vice versa. And certainly, obviously, more specifically, the popularity of certain opportunities has changed over time. Right, we had DeFi summer not too long ago. I think now there's maybe more focus on, let's say, liquid staking, on a geographical axis. Right, there's been with all of the regulatory news in the U.S., there's definitely been a shift of focus offshores. But again, right, those are very specific kind of maybe market trends. Whereas overall, I think the opportunity has only expanded, and hopefully with a maturation of an asset class too, it just becomes more readily available to execute within the space. Then on kind of the infrastructure side, to actually take advantage of or execute on these opportunities, really, I think it's more on one hand, right, reliability, uptime, but also kind of the flexibility of that pivot, right? Being able to change course, to adapt to new market conditions or new opportunities. So really, as a more active or sophisticated trader, I think the infrastructure needed, kind of focuses on those points, and going back to kind of those earlier struggles, right, that traders deal with. Most of that is about solving for fragmentation, microstructure, capital efficiency, and execution. Maybe I'll throw in kind of market data and analytics in there. You have to get your signals from somewhere. But if you have a kind of single platform that can solve for those struggles, right, that essentially means that you have the ability to adapt, to execute regardless of market conditions, to express a view in the asset class. And that's of course all things that we at sFOX are primarily focused on, right? We are not the alpha generators. We are the tools that alpha generators use to execute their strategy. I think here I would love to hear from the Valmar team as well, right? They're much more on the asset allocation side, and you guys are kind of take a similar, I guess, approach in a way to us, but as an allocator to managers, whereas we are the more on the infrastructure side. How do you guys see kind of the opportunity changing at this point?
I think I would echo what you just said, right? Like because we're still fairly nascent, but our industry is continuing to expand. New ecosystems, new tokens. We've gone from just having spot markets to data futures to perpetuals to options, and so we're bringing on more different types of instruments in order to to lay off risk or to express a view. And so yes, like I see that I feel like this market continues to present new opportunities now, and I agree with you that over time that opportunity set continually shifts, right? And so like to your point, like DeFi summer was really popular. There was yield farming, which is very popular, and then options like yield harvesting, volatility harvesting was very popular. And so like over time, like the popular trade will move from one to the next, right? But there's always going to be an opportunity to generate alpha for the foreseeable future.
And that's where the flexibility is so important, right? To be able to shift that capital when you need to shift that capital, because as Jonathan just said, the themes of what you'll invest in rapidly shift, and so we really view that if you can kind of connect all the desks that need to be connected in the circle, you can push that capital around that circle as it needs to be pushed based on your variety of macroeconomic conditions that'll just affect where the good strategy should be trading.
I think, Jonathan, you raised a really interesting point earlier too, right? The trade changes. I think, and I'm curious to get your input on this. One of the things I think is so unique about crypto is that typically, when the popularity of a trade in traditional asset classes kind of fades away, that's because it's gotten too efficient. The opportunity is not really there anymore. I think that's maybe less of a trend in crypto. It's the trade might still be there, right? The basis trade might still be there. Yield farming is still available. I don't think it's necessarily an efficiency problem. It's more just a shift of focus and the constant kind of iteration and expansion of the space overall. Yeah, what do you think about that?
Yeah, I agree to a certain extent. Like I think that in this market, it's not necessarily that the trade got too overcrowded. Like for example, like take the basis trade, long spot, short futures, right? Like that trade was really kind of driven by like excessive exuberance in the market, right? And like so the more bullish you were, the more your funding rate was willing to get driven up, or like the bigger of a contango you could have in the futures curve, right? And I think that can come back, right? Like if the market were to stabilize and more people entered into the space, there was just a stronger bullish sentiment that can come back, right? Yield farming also can come back because like in yield farming, like a lot of the yield comes from like the reward token that you're receiving, right? And right now, all token prices are depressed, right? And so that yield is no longer as attractive. But if there were a scenario again where like the market were to turn back up, then there's a potential for that to come back, right? But I would say on the yield farming side, that it also is a matter from the yield farming side, it also is kind of like quite a bit of experimentation going on, right? And you think about yield farming, it's really just like a way to try to acquire customers, right, for your protocol. And there may be a rethinking behind that. And I'm not quite sure how that will change yield farming, but there'll be some impact, and I'm sure people will figure out a way to profit from that as well. So it's all kind of related.
So guys, I want to take a step back and put this question to all of you, because we've talked a lot about sort of the cycles of strategies in crypto and the extent to which it's similar and different from other asset classes. But let's say I'm someone who's interested in getting exposure to the crypto asset class for the first time, whether that's subscribing to a fund, starting my own fund. What are kind of the considerations I should be thinking about? And one of the reasons I ask this is coming from a position at a place like sFOX, a lot of the infrastructure that seems to be coming from those service providers is kind of emulating best practices from the trading of other asset classes. A lot of these things in terms of execution, security, it doesn't seem as if you oftentimes need to reinvent the wheel. But I think for many people approaching the asset class for the first time, it might seem as if whether it's something in the regulatory space, something in just the technical considerations of owning tokens, there are unique considerations that one has to manage. So how would you recommend navigating those concerns in terms of what you can port over from TradFi and what you can't as you're trying to enter the space in a responsible and savvy way as a sophisticated investor for the first time?
Yeah, I mean, I'll tell you, at least from my perspective, it all comes back to understanding the risk management of the investment which you're getting in, right? I think a lot of there are bespoke ways of generating yield in this space, but there are a lot of similarities to traditional strategies. Where it can get tricky is some of the bespoke aspects of risk management, 24/7, 365 environment, increased regulatory exposure, increased counterparty exposure, increased black swan events. So there are disciplined ways to handle this in traditional finance, right? But how do you port some of these over to the very unique way in which they appear and apply in digital assets?
Yeah, I mean, I can add and maybe speak about the differences for an investor that wants to allocate capital into the space. There's a number of different options, just like in traditional finance. There's there used to be people with a couple of Bloomberg terminals and all the way to very sophisticated funds. In general, you would find that for institutional investors, the things to look for in a fund or in a manager that you want to allocate capital to are similar. There's definitely core elements, whether it's the strategy, the team, you got to do due diligence, the operations, the way they handle risk at all levels, market risk, counterparty risk, and liquidity, cybersecurity, legal compliance, regulatory, and the service providers, and all of that is kind of the same. So if you want to invest, certainly have the opportunity to invest with your nephew that has done great in the past 5 years, and you're just giving them money. But if you want to invest properly, then you got to think about these things. Crypto definitely has specific elements that make the setup and things that you had to look for and you had to review from an allocator perspective. The specific technology is different, right? So yes, you were saying, Aaron, that there is you don't have to reinvent the wheel, but they are, to a certain extent, the technology systems that need to reinvent the wheel. So that you don't find a lot of the legacy systems here. You find a lot of systems that have been developed over the past few months or maybe a couple of years, and they are embedded. So, and they're basically being developed as we speak. The setup of compliance and regulatory, obviously, it's right now, especially in the US, is a big mess, right? So we've seen the development with the SEC, the lawsuits against Coinbase, Binance, and people, literally managers fleeing the country to set up somewhere else, whether it's in the UK, Switzerland, Dubai, or some other places in Asia. And so, until there's clarity from that point of view, it is hard for a US allocator to kind of decide what's the best thing. I mean, this thing with Binance and Coinbase could drag on for years before the court kind of settles things. Nothing's going to happen from Congress, these are peculiarities about the space that an allocator need to think about. And risk management is like Joe was saying, is a totally different beast. because yes, you have the standard elements like market, but when you get to counterparty risk or custody risk, things just work in a different way, and you had to be able to analyze and review what a manager, what a trader is doing with your money, with your digital assets, and what counterparties they're choosing how they're diversifying their risk across counterparties, and how they're thinking about cybersecurity and all that. And there's definitely, these are elements that are the same, but they are treated and they behave in a very different manner in the crypto industry, right, as opposed to traditional finance.
I'm glad that you brought up considerations of regulation, Luca, because I did also want to talk about the C word, by which I mean compliance, of course. I'm sure that's on many people's minds if they've been looking at the news in crypto over the last while, or indeed if they're on the sidelines thinking about getting exposure to digital assets in their portfolio, especially if they're within the US. I imagine many of them are wondering, like, is it even possible for me to take on exposure to these assets while remaining compliant? Jack, maybe I would put this to you first, but I'd love the whole group's opinion on this. But because I know sFOX has been really self-consciously focused on regulation and compliance considerations since its inception and is US-based and largely serves US clients, like, how would you advise people to navigate that in terms of determining whether or not they can even own and trade these asset classes? And is that possible in 2023?
Yeah, I think the short answer is I do certainly believe that compliant investing in the US is still possible. I think for an individual investor and even more sophisticated investor, definitely maybe requires more active vigilance than traditional markets. For example, right, if you're an active US trader, you don't want to be kind of forced to close a position if the asset that you're holding on, exchange A, turns out to have to be delisted, and now there's no longer a place to kind of trade that asset. So as a longer term holder, I don't think that necessarily applies as much. Right? There's plenty of kind of great custodian solutions, including sFOX, right, with the launch of sFOX Safe. But I think really as an individual investor, I would recommend staying up to date with the latest news, especially as it relates to your kind of chosen trading platform if you're using one. Here at sFOX, obviously we're very frequently kind of updating our clients regarding any changes or updates as US compliance guidelines change as well. And there's hopefully kind of further clarity coming, maybe let's say in the medium term, for better or worse, I guess, as a result of the recent kind of SEC charges against Coinbase and Binance. That, yeah, I do hope will at the very least give us some additional clarity in the States. And then I think it's still kind of a responsibility of the investor to look for signs, within your chosen platform, right? Are they communicative? Are they kind of transparent and open about their own compliance programs, their licenses, their regulatory guidelines? So I think, yeah, there's certainly some signs that you can look to as an investor to ensure that you're working with a platform or counterparty that is compliant. But yeah, would love to hear from the Valmar team on this too. I think as you guys are allocating pretty diversely.
I can start here, then Joe and Jonathan can add. I think yes, it is possible, and I agree with you that the devil is in the details, and you have to sort of do your due diligence on the platform that you're using. And there's some good ones. There's always something new coming up, and suggesting the Holy Grail. But it's important to do your due diligence and deal with platform that that try to walk the right way. With that said, there is a lot of ambiguity at the moment in the U.S. We have been talking to several law firms and about the issue. Can we can we invest? Can a U.S. investor invest here in the U.S.? Can we set ourselves up in the U.S. as U.S. managers? And we got several different answers. Some yes, some no. And we, as I said before, we're seeing some of our peers setting up in Dubai or in the UAE, in Singapore, Hong Kong, UK, Switzerland, and it just it is unclear, right? Because the SEC is not clear about what is a security, what is not a security. It's not. I mean, they come out with recently with a proposed custody safeguarding rule that sort of suggests that everybody will not be compliant. So if you want to do trading, unless you want to just keep your coins in your wallet, in your cold wallet, I mean, if you start trading and then you basically are in violation of the new safeguarding rule, which has not been approved yet. But and then you have these lawsuits that will drag on for a long time, and so. So I think I think it's possible, but risk is there, and it's important to go back to your point. It's important to deal with the right counterparties, get the right legal advice and the right structures, and whatever. For example, in the case of custody, it is not possible to be compliant with technically with the custody rule, because you technically have to have custody of clients' assets at all time, which means that you need to keep your assets at all times in a qualified custodian. But if you wanna trade, you have to take the assets out of the cold wallet, and at that moment you're technically in violation. So far, people have dealt with this problem by with designing comprehensive policies and procedures, and the SEC has not been enforcing anything on these cases. But it looks like things are changing now, and the SEC is kind of flexing his muscles. And with the new rules, so again, possible, but it will be an interesting time ahead to see where this is going. And I'm glad that Coinbase, with all the resources, Binance, I suppose, are fighting this battle on everybody's behalf, because it's long overdue.
Well, friends, we have about 9 minutes left in the conversation, so I will remind our audience, if they're interested in Q&A, feel free to send in those questions. But until then, I have plenty more, so we're all good. I'll change gears a little bit. I want to go back to a theme that, Jonathan, you called out earlier, just in terms of diversity in the sector, in terms of all the different projects and opportunities and token types that are out there. And I know, even as someone who's in the sector, I can feel overwhelmed by trying to navigate all of the different blockchains and their foundations, and utility tokens versus DeFi versus security tokens. And I know in fact that if you can wrap your head around all of that in the right way, it can be all the more positive and promising to be able to develop a range of strategies across a portfolio in order to really generate alpha and benefit from everything that's happening in the space. But as someone who's getting into it for the first time, what would you say is the best way to wrap your head around all of those different kinds of opportunities out there as you're evaluating different sorts of projects?
Yeah, I would say, unfortunately, my take here is probably that you should leave that to people who that's like their full-time dedicated job, because it's so specific and so niche for you to really understand like each protocol, like even if you start at like the highest level, like with different layer 1 blockchains, right? Like each of these have their own like specifications, their own technological roadmaps, their own scaling solutions, their own tokenomics, right? And then within that, they have their own different ecosystem of applications, right? And so there might be like a DeFi ecosystem for Ethereum, a DeFi ecosystem for Avalanche, and there's this it's just so vast. So I actually would say that if you're coming into the space and you're starting out, like you actually do have to keep it simple, right? And I would stick to most likely Bitcoin and Ethereum, right? Kind of get that beta exposure, right? And anything beyond that in terms of like either like seeking alpha through asset selection or seeking alpha through active trading. Like I really do think that should be left to the professionals at this given moment.
And then, Jonathan, what I would add is it's also very important to keep in mind that there's a stark difference between investing and trading, right? So, long-term, investment in particular names because you like them and, are putting a comfortable amount of money in there, fine. Much different profile than, sort of sophisticated active trading, in especially in like, higher frequency strategies, towards market making, stat arb, that type of stuff.
Guys, we just got a question from the audience, and so with an eye to the time, I want to make sure we can address it. It's for Valmar with more details really on what it is y'all are up to. So I'll punt that over to you guys. Jonathan had mentioned Valmar being a platform for independent managers to use and not just a fund of SMAs. Could you speak a little more to what that looks like and provide more color on what the service consists in?
Yeah, so ultimately, if you think about our goals, like from a portfolio standpoint, right? Ultimately, we want to bring together a diverse basket of strategies that span market neutral to directional, quantitative to more discretionary type trading, fundamentally based versus more like algorithmic, and really just to be able to provide extreme diversification across all of these different types of metrics into a optimized portfolio to generate risk-adjusted returns in the crypto space. And so in creating that that portfolio, we work with more established type managers, right, or more independent proprietary type strategies. And so in terms of services, right, we put together a out of the box experience, right, that a technological stack that covers execution, risk management, portfolio management, our institutional operations, in order to really make it as easy as possible for managers and strategists to focus on what they're good at, right? Which is managing capital, finding alpha, exploiting markets, in whatever fashion that may be, right? And our job is to manage the risk at the overall portfolio level, and to be able to provide that institutional quality infrastructure in order to pass and satisfy the requirements of the institutional investor.
Really helpful color, Jonathan. Thank you. Now, since someone has broken the seal on asking questions, of course, we're getting more. So I'm grateful for that. Someone else asks, and this is a nice one actually to start wrapping things up with. What is one misconception or source of confusion you routinely see from clients who are preparing to make an allocation to Bitcoin or crypto more broadly? And Jack, maybe we can start with you because Valmar spoke last, if you have a view on that. But I'd love all of your views on it.
No, it's a great question. Yeah, I'm trying to think of the most common. I think, I guess one kind of struggle that I think some clients face when making their kind of first allocation is understanding the differences with interacting with crypto, but really I think a lot of those have deep similarities to traditional solutions, right? One recent case actually was just the flow of a deposit to a trading platform, right? What using a deposit address, sending Bitcoin, let's say, to that address, what that all really means, how it all kind of happens, and to that end, right? You could still make, while very different and processed very differently, you could still make a very similar parallel to, say, processing a wire transaction to your brokerage account, right? You're just funding that account to a specific kind of destination address. Otherwise, I think for a typical investor, right, the look and feel will feel very similar to a normal kind of brokerage platform, right? There's the concepts are the same, right? You're buying and selling, order types can even be the same, but understanding that that it actually is somewhat the same and operating similarly to trading that way, I think can be a misconception, right? It's a new asset class. You think maybe there's something that, and it looks familiar, but is there something I'm missing? And yeah, I think that's a common misconception, right? I don't think you're really missing anything. It's somewhat straightforward to that kind of basic example.
Yeah, and Jack, we would very much agree with that point, right? Especially on the investment manager side of things, right? For when an investor is doing their due diligence, sure, there are unique aspects to the marketplace that need to be considered, but overall, do you trust the team, and are they reputable? Do you understand the strategy and how they generate yield? Do they have active risk management to deal with exposure, liquidity, every other market force that they might come across? Is the service provider set up good? And I think being disciplined in that approach as well, right? As an investor, which is to say, this is a new asset class, but don't let people mechanic shop speak you into overcomplication or why things are so starkly different. If something's not passing the sniff test from a general due diligence standpoint, it's probably not passing the sniff test.
Well put. Well, friends, I think that'll do it. We have a lot more questions. I have more questions for you, but maybe we'll figure out a way to do some nice follow-up material for those people who are interested. This has been such a wonderful conversation. I want to thank all of our esteemed guests, Jack, Jonathan, Joe, Luca. Truly, thank you for making the time to give your perspective on the crypto sector, what sophisticated investment in it looks like in 2023. I guess I'll cheat and extend time a little bit, because I do want to wrap up by asking you, we haven't been that forward looking in terms of what's coming next. So very broadly, what has you most excited about the digital asset sector in the next, say, 5 years?
Yeah, for me, I'm really excited to see more kind of real world use cases emerge, right? And like one of the things that's starting to pop up is real world assets being ported onto the blockchain. And I really think that is potentially one way for crypto, for digital assets, blockchain technology to really demonstrate its value to the rest of the world in terms of efficiencies, disintermediation, all of that. So that's what I'm really excited about.
For me, somewhat related, as use cases and the technology in the asset class consolidates, I'm excited to see the institutionalization of the asset class and the investment management industry within the asset class, because we've seen in the past what just running a non-institutionalized firm brings. So that's our mission, and we're excited to see the rest of the industry follow suit.
The people and the talent those that have remained in the space, right, and those who continually join the space. I know personally speaking, that's why I'm still here, right? I get so much, I'm a better person, I think, from operating with people who are as high caliber as the good ones are in this space, right? It's very energetic. And I think that's why, you know, ultimately the writing on the wall for me was, you know, there's so many smarter people out there, right? Your job is to now think about creating ecosystems for these people. So that's really what excites me.
And I'll end up there and kind of take a similar answer to Jonathan, but slightly different tact, and something we were talking about before the webinar actually was, I'm really focused on allowing kind of our clients and new investors in the space to engage in more of the decentralized applications and just the broader ecosystem as a whole in an easy way. I think that's been kind of a large overall barrier to entry for the average investor, and really see where that takes us. Right, I want to learn from our own clients, from our users, what those real world applications are, what is exciting, and I think if we can lower that barrier to entry and make engaging very seamless. Hopefully, we can see some pretty interesting results.
Gentlemen, again, thank you so much for your time. To our esteemed audience, thank you so much for tuning in. We'll be following up with a recording of this webinar, which you're free to check out and share anytime you like. Whatever your digital asset management needs are, I really encourage you to check out both sFOX and Valmar Capital, depending on the particularities of your case. But I can speak from a few conversations now and attest to the fact that these guys, like everyone else at Valmar and sFOX, are some of those best minds that Joe is talking about in the space, friendly, willing to help you on your journey, and want to see everyone win together. So don't be a stranger. Thank you for checking this out. I really hope you enjoyed it, and look for similar content coming from sFOX and Valmar in the near future. Thank you, everyone, and stay safe.
Thank you, Aaron.
Trade well.
Thanks for having us.